Hello, everyone. Thanks for joining me today. Today, we're actually going to be talking about and covering a critical topic for your Shopify stores. And that's really how to effectively close your store's books for the end of 2024. This process ensures accuracy and lays out a strong foundation for successful 2025. So I'd like to open today with a verse from Ecclesiastes chapter 3, verse 1. To everything there is a season, a time for every purpose under heaven. As we reflect on this year's accomplishments and challenges, let's ensure that we're prepared for the coming season with confidence and clarity. My name's Jacob Curtis. I'm a CPA, certified professional, and a business coach. And I started Curtis Accounting Solutions to remove the stress of doing the bookkeeping and payroll and taxes and to provide practical business advice that helps Shopify stores piece together financial freedom. I'd love to hear your thoughts and questions on today's episode. So please leave a comment below and remember to like, share, follow, subscribe, and all those good things. Okay, let's dive in. Our first step is reconciliation. We need to reconcile every bank and credit card account that you have in your books that belongs to your business. This means comparing each transaction on your bank statement to what's in your accounting software, ensuring every sale and expense is correctly recorded. And ideally, you'd be doing this every single month. Now, for an example, if your Shopify income for December shows you have $10,000 in your books, but your bank account only reflects $9,800, this is a discrepancy that could be due to an error or a fee or an expense or something, and so you need to investigate that for further accuracy. Another example, imagine that you had a refund for a $50 return, but didn't get that recorded into your system, and correcting this error now avoids the complications later during tax filing season or financial analysis. Also, you want to check for the unrecorded bank fees or Shopify transaction fees if that may be applicable. For example, if you pay a 2% processing fee on $10,000 in sales, your account should reflect a $200 processing fee expense or deduction in your books. So keep these reconciliations consistent to prevent these kind of errors and making sure that you're getting all the deductions you can. Once you've reconciled, you want to review and categorize all your expenses. Again, ideally, you'd be doing this every single month, if not weekly, on the categorizing part of it. Each transaction should have a proper place, like marketing or inventory or office supplies. And this is essential step for understanding where your money went and making sure you maximize those deductions. Say, for example, you had $500 in ad spend in November. You want to ensure that's actually properly categorized under marketing, not supplies, to make sure you have correct reports and can use those reports later on. This precision benefits you at tax time, allowing you to have those clear deductions. Another example, let's say you spent $2,000 on Facebook ads and $3,000 on Google ads throughout the year. Categorizing them as advertising rather than separately, this helps to identify total spend for the year and gives you a clearer ROI and return on that investment is part of your analysis. Remember to review those subscriptions and recurring expenses like the Shopify app. If you're using an app that's not adding value, consider removing it so you can reduce your costs in the coming year. Next, let's handle inventory. Calculating year-end inventory value, taking that into account the items that you've sold, any kind of shrinkage, any kind of write-offs or damaged goods. This is all crucial for an accurate cost of goods sold. Now, suppose your inventory on December 31st is valued at $15,000. If you had $1,000 in damaged goods, you'd want to adjust that inventory value accordingly down to $14,000, helping you to reflect the true value and cost of what you have on hand going into 2025. Also, take note of unsaleable items. If you have a stack of unsold seasonal inventory, consider a write-down. For example, $500 worth of holiday-themed products may need to be reevaluated, impacting your overall asset and giving you a greater reduction. Now, keep a consistent method for evaluating your inventory, whether it's average or first in, first out, or whatever it is. You want to make sure that you're keeping a consistent method for evaluating your inventory to ensure accuracy year over year as you're comparing your reports. Now, you may not have accounts receivable, but maybe you do. This is the amount that customers owe you. So double check those payments and make sure that they have been received and they're properly marked as unpaid. Anything that doesn't come through, you may want to write off as part of the necessary adjustments for your business. Suppose you have an invoice for $1,200 in December, but $200 remains unpaid. Confirm that it is accurately recorded in your accounting ledger to avoid overstating income and making sure you take the deduction if it's not going to be paid. Tracking your partial payments made against outstanding invoices is critical and could cost you some money if you don't do it right and don't keep up with that. Now, for a lot of retail and e-commerce, you won't have accounts receivable. So on the flip side, you want to look at accounts payable. You want to confirm that you have all of your unpaid bills are actually recorded in there, right? If you're on the accounting accrual method, you want to make sure that the bills that you've received have been entered into the system to reflect what you still owe to your suppliers, giving you an accurate snapshot of the year-end liabilities. So if you owe $500 to a supplier for December's orders, include that in your accounts payable. If it's unpaid, it helps inform budgeting and cash flow for January. Now, another one is record any outstanding vendor payments, like a check that you may have written for $250. If that hasn't been cashed yet, you still want to make sure you have that on books so you know what that is to help you maintain a complete picture as you move forward into 2025 and help you with that cash flow. Another point to consider is negotiating your payment terms with your vendors, especially those that you frequently use and have a good relationship with. Vendors may offer discounts for early payments, saving you money in the long run. So make sure you verify and settle any sales taxes that you owe. Usually those are due a month or two or quarterly, but double check these against your state requirements that you may have economic nexus in. That is including your home state and any state that you may have to pay into. So if you've collected $2,500 in sales tax for December, verify that this is the correct amount, that your liabilities reflected properly on your financial reports so that you can remit that and send that payment into the state before the deadline. And that brings up a good point. You want to be aware of when those deadlines are so you can avoid penalties. So for example, if January 15th is your deadline, prepare that statement and payment early to avoid any last minute kind of issues. Finally, calculating your year-end profit is crucial. Start with your gross revenue, subtract out your COGS, and then the rest of your expenses to determine your bottom line or your net income. The final profit number should match your books, right? You can do kind of a back of the napkin kind of math for yourself and get close. But then you also want to make sure that your books, your accounting records, whether you're using QuickBooks or another program, is up to date and accurate. Once your records are complete, you want to prepare your financial statements. Now, QuickBooks automatically does this for you, but this includes your income statement or profit and loss statement, your balance sheet, your cash flow statement. These will give you a complete view of your business's health, and that will really help you understand what we want to do. These statements provide a valuable insight into summarizing the year for 2024 and can help you make decisions for 2025. As a profit first business, hopefully you are a profit first business, closing the year includes a critical step, which is reviewing your allocations, your transfers between your accounts. Profit First divides your income into dedicated percentages to support profit, inventory, owner's pay, taxes, operating expenses. Reviewing these allocations helps ensure each category is adequately funded and that you have enough in there. So if your total income for December was $10,000, based on your percentages, you may end up allocating $300 to profit, $4,000 to inventory, $2,800 to owner's pay, $900 to tax, and $2,000 to operating expenses. Now, again, this depends on your personal percentages for your business, but this will help ensure that every dollar has a designated purpose supporting your financial health. So adjusting those percentages as you review the last few months, you want to adjust those because there are seasonal fluctuations and you may need to make adjustments for larger income spikes and things like that. Adjusting these percentages can really help prevent cash flow shortages and prepare you for the slower months. So take a few minutes to review your historical percentages. And if your operating expenses have exceeded your target all year, let's make an adjustment in those allocations for 2025 to reflect this trend while still aiming for profit and sustainability. Our final step is all about setting up success for 2025. Planning now will make sure you start the year with clear, achievable financial goals. Organize your records and budget that reflects your unique needs. Let's say you have a goal in 2025 of increasing your revenue by 20%. Map out how that's going to impact your budget. For example, if you need to increase your ad spend by 10% to reach this target, update your operating expense allocations to reflect that. Or another example, if your inventory costs rose significantly in 2024, prepare for that in 2025 by adjusting your inventory allocation in your Profit First and making sure that your pricing is reflective of the new cost of your inventory. So if you typically allocate 40% inventory, but maybe now you either need to increase your prices to maintain that 40%, or we need to adjust those allocations to account for 45%. I would probably tend to recommend that you increase your prices to maintain your profit margins, but that's up to you and what your market and your customers would like to do. Lastly, organize your records by archiving older documents and categorizing current ones into their different kind of types. Nowadays, a lot of this is digital, but sometimes we still have some paper records. We want to get those filed and kept clean so we have those. So that when the tax season hits, when you're sending your documents and supporting information to your accountant, it's not a back and forth and they're not going to charge you an extra fee for all the hassle. Everything's ready to go for you to do. It also allows you to make easy comparisons year over year, especially if you have a clean QuickBooks file or a Zero file and your accounting system is clean and ready to go. Makes things super easy to help you set things going forward. So but please feel free to reach out if you have questions or need assistance managing your company's finances. Don't hesitate to reach out to me. I'm here to help you piece together financial freedom. You can schedule a call with me by scanning the QR code here or by going to Jacob Curtis CPA /7-Shopify-mistakes-calendar to get started. And remember to follow me, Jacob Curtis CPA at Curtis Accounting Solutions on Facebook, Instagram, Pinterest, and YouTube. Thanks again for watching, and we'll talk to you all soon.